Welcome to our first webinar of 2024. We have been getting a lot of questions here at Better Money Decisions about comparing portfolio returns to what's happening in the market. And we know 2022 wasn't a very good year, 2023 was a much better year, and yet many people are finding their individual portfolio returns vary greatly from what they're hearing on the news. So my colleague Rick Ha and I are going to spend a few minutes discussing returns and what that really means and how to compare what you're doing with perhaps what you could be or should be doing in terms of return. So with that, I'm going to turn it over to Rick for a few minutes, and he's gonna get us going here.
Sounds good. Hello, everybody. We could go to the next slide. As Leanne mentioned, from time to time, we do have clients that are obviously hearing the news, and they hear the Dow is hitting records, or the S&P is hitting a record high, and they'll say, "Well, is my portfolio performing the same way? We don't seem to be as increasing as quickly as the S&P or the Dow." And so that question pops up from time to time. Why is my portfolio not performing like the market? And it's really not the best question, just in the context of financial planning and portfolio management, but we can certainly start to address this. If we want to go to the next slide. First of all, what is the market? I think what we hear mostly on the news, what is reported on a readily and daily basis, we talk about the Dow, the S&P 500. If you want to click onto the next bullet points that pop up, the Dow, the S&P, and the NASDAQ, they seem to be mentioned every day in the news. But this really is not an accurate portrayal of the total U.S. market, and it's not really an accurate portrayal of what your portfolio is. If you want to click one more time, the S&P has a total of 500, but the Dow has only 30 stocks in it. It's a very, very small market segment. The S&P, it's a little bit better, but it still only has 500 stocks in its representation. The NASDAQ is probably a little bit more broad, but it has kind of a special niche in that it is a market exchange. It has roughly on average about 36 to 3,700 stocks. But the total U.S. market really has over 7,000 stocks in it. So to just use a comparison to the Dow and the S&P becomes a very small sliver of what is going on in the broad market. And certainly that's really not indicative of what you are invested in. If we want to go to the next slide, what is this an accurate comparison of your portfolio? And really the short answer is no. And the reason for that is you're not just invested in the Dow or the S&P or even the NASDAQ. Anytime you're working with an advisor, typically you're going to be invested in a model portfolio that has extensive diversification and asset allocation into other markets. We hear these terms diversification and asset allocation a lot, but what does that really mean? Well, there are other markets that your portfolio has exposure to. In the U.S. markets, which is the Dow and the S&P, is just that small segment we see up there on the left under U.S. equities in large cap and a little bit of mid exposure. But we also have exposure to small cap world. We can differentiate between value and growth oriented stocks. We also will throw in components of international equities. We mentioned the U.S. market has over 7,000 stocks. The international market has over 15,000 securities that can be invested in. Now, obviously, this can be split between developed countries, countries we're very familiar with in Europe primarily. But there's also emerging markets that also present investment opportunities that we do have exposure to. Probably the biggest impact on why your portfolio doesn't perform like the Dow or the S&P is that on the right-hand side there, the fixed income or bond market. Pretty much any invested and allocated portfolio is going to have some weighting in the bond market. This can be as small as 10 to 20% in more aggressive portfolios. In more conservative portfolios, this can be as high as 60, 70, or even 80% of the portfolio can be in bonds. Bonds perform very differently than equities, and oftentimes they actually perform inversely, or they're not correlated at all. And again, this could be government and corporate. It can be short-term maturities or long-term. We can have higher quality positions like government positions, but we can also do lower quality. You hear the term junk bonds. They present an investment opportunity as well. And there's also the differentiation between US bonds and then bonds from overseas, the international market. So any diversified portfolio is going to have a much broader selection of what we would refer to as markets than just the S&P or the Dow or even the NASDAQ. So this kind of begets the question of what should I be comparing to? If I'm not supposed to compare to the S&P or the Dow, what is the best comparison? Well, the answer to that is simply if you have completed a financial plan that has a long-term retirement projection in it, the assumed rate of return within that plan is your target rate of return. This is what you should be comparing to. And it is customized. Specifically, this is customized to your retirement goals, your investment goals. It's based upon the actual portfolio allocation you're invested in. It meets your risk tolerance. I mean, some people have a higher risk tolerance than others. It also meets your time horizon. I mean, do you have a long time to retirement and then through retirement? But this is something that's customized to you. The S&P 500 is not customized to you. It's just an arbitrary measurement that's out there. So where do you find this number? Basically, if you have completed a financial plan with your advisor, and there is an assumption that your plan has a suitable probability of success, it is going to be higher than 75%, meaning that there is a high likelihood that your financial plan and your retirement plan is successful. Inside that plan, there is a target rate of return. That target rate of return, then that is what you should be focusing on in regards to what is your target. Now, this is a longer rate of return. There's ways to deal with short-term volatility, but this is where you should start. This is the point at which you should say, okay, what is the number that I should be looking at in my portfolio? We can take a look at some target rates of return. These are target numbers that are right out of our financial planning software. These are for the many different models that are in there. On the left-hand side, you'll see the model. And within the industry, our nomenclature is, oh, you're in a 20-80 portfolio or a 60-40. What this simply refers to is the broadest measure of portfolio diversification or allocation. The first number is the percent exposure to the broad equity markets. The second number is the broad exposure to the fixed income or bond markets. So the 20-80 portfolio, you see the model, is 20% equities and 80% fixed income. Now, in the whole broad scheme, what of the S&P is in here? Very, very minimal. It may be less than 2 or 3% of the entire allocated portfolio. And as we go down the scale, you see we have more equity exposure, all the way down to 100% equity and no bond exposure. But each step down the ladder, so to speak, if you look at the target return on the right-hand side, our target return gets a little bit higher. And that's simply because we have higher equity exposure with each step down the ladder. So, something very conservative, the 20-80 allocation, our target return is 4.23%. If we go all the way down to the most aggressive, 100% equity, we're going to be at a 7.45% target average annualized rate of return. Now, most of our clients are somewhere in the middle, depending upon their proximity to or whether they're in retirement. But the 60-40 allocation, right around 6% at 5.9, is probably a good starting point for any broadly diversified or allocated portfolio. That's really the way to look at this and the way to think about your return. Comparing to the S&P doesn't really do you any good because what do you get out of the S&P? It is just a market measurement. What's more important is your specific target return within your financial plan. Leanne, you want to go on to the next one?
I would say, I know you and I have been in this business a long time. When I first started, that 60-40 target return was probably around 10%. Something more aggressive might be even 12. And we've seen those returns those expected returns and real returns over time come down. And so sometimes when we are going through a planning process with a new client who maybe still remembers the good old days of 10% returns on a diversified portfolio, there can be some adjustment in expectation here. But it's important. It's important from a planning perspective not to overestimate what we think your portfolio is going to earn going into the future. And we're going to talk a little bit more here about how these returns, we're not coming up with these out of thin air. So let's talk about that, how those expected returns happen. So our financial planning software and any reputable financial planning software will have similar process. Works very closely with an academic group of economic forecasters, and this group was started by a professor at Texas Tech named Harold Avensky, who really specializes in forecasting investment returns and analyzing economic conditions, especially in the context of financial planning. So there's a lot of work behind the scenes that goes into figuring this out. These tend to be updated about every 18 months to 2 years as circumstances change. But the idea is that we really want to see what are the returns that we can expect for each asset class. We're not trying to predict if Apple's going to go up by 10% or your bond is going to go up by 5%. We're just saying by asset class, what do we expect the return to be on average for the next 20 years? And then that helps us figure out a blended target return if we put together a portfolio of all of these asset classes. Now, part of what goes into that calculation too, which I think is very important here when thinking about return, is that each asset class has a different risk profile. For instance, bonds, usually, 2022 was an exception to this rule, but usually are pretty stable. We tend to use bonds as downside protection, protection against an equity market decline, because they're really not designed for growth. And therefore, their risk profile is pretty low in most cases. The flip side of that, of course, would be something like emerging markets, which is probably the riskiest or one of the riskiest asset classes that we typically use in a portfolio. Some years it will do very, very well. Some years it will not do very well. And there are some specific reasons for that, but emerging markets tends to be one of the riskier asset classes. So when we're putting together portfolios, we're not going to give you 50% in large cap and 50% in emerging markets. We know that different asset classes, we want more weighting in those that are more stable, where we can maximize our return for the amount of risk that we're taking. And again, all of this gets layered in with inflation assumptions as well. So you start to see that expectation of return requires a lot of mathematical and economic forecasting and to come up with this blended number. So I wanted to show you, because diversification is so important in your long-term success of a portfolio, that a big reason for diversification is that we can't really predict what is going to do best and what is going to do worst each year. We can have some ideas about what might do well and not so well, but as you can see from this chart, this is called the Callan, it's done by the Callan Institute, from 2004 to 2023, so we're talking about almost 20 years here. Every year, for the most part, some asset class, different asset class was on top. I will tell you, just thinking about emerging markets again, when I look across this chart, emerging markets was on top 4 years out of the last 20, but it was also on the bottom 4 years out of the last 20. So, and it was in between in all those other years. So here again is a reason why we can't assume that if we're in only in the S&P 500 that we are going to be at the top of this chart and blowing the lights out every year. So I always like this one. Any thoughts on that, Rick, before I move on?
No, this can be a confusing chart to look at, but if you kind of
Busy.
look at it, the theme is easy. Just look at the top row, and very rarely do you see one asset class repeating as the best performer every year. And you can do the same thing. Look at the bottom row and see what's down there. So it's a definitely a mix, and it definitely moves around. And again, this is why it's very important not to focus all on one asset class.
Right. So again, just reinforcing this message here that blending is better. I'm not a cook, by the way. I don't know anything about cooking. I eat wonderful food. My husband's the cook. So, but what I did learn from watching him over many years is that to really make a special dish, you have to think carefully about your ingredients. And even if you love salt, for instance, more salt doesn't always make for a better dish. So I would think about this. If you are going to be diversifying and comfortable with diversification in portfolio, it is very much of an art and a science to come up with the right mix, because we're not going to put the same weightings of every asset class in your portfolio. Okay, so Rick mentioned a few minutes ago about short-term market volatility. What do you do when that happens? Because that's where the news is. That's what drives people crazy. And here's something to just keep in mind, to take a step back. A really diversified and properly allocated portfolio is probably going to perform behind the market during equity growth cycles. We saw this at the beginning of 2023 when the Magnificent Seven stocks were the ones that were driving the increase in the S&P 500 and in what everybody was quoting about what the market was doing. And that can make you feel very frustrated because your portfolio is probably not going to do that. Now, that was a little bit unusual to have such a narrow band of performers there at the beginning of the year. We, of course, saw by the end of 2023 that the US stock equity markets had broadened their recovery, and we were starting to pick up steam across more sectors, which helps more portfolios and more of your portfolio. But again, during equity growth cycles, we're probably going to be a little bit behind that. Doesn't mean we're not participating in the growth. But what's more important here is that we believe it's better for our portfolios to perform ahead of the market during down equity cycles. It's not, as we've quoted here, it's not what you gain in a growth market, it's what you don't lose in a down market that counts. We've seen that psychology with investors over and over again. It's much more painful to watch your money go away than it is joyful to participate when it increases. So we understand that, and that's how we design our portfolios, is to try to protect on that downside. And in fact, this is a great example of what's happened over the last 2 years. Here is a 60% equity, 40% fixed income portfolio, which many of you may have, versus what was happening in these different indices. 2022, a 60-40 went down almost 12. But the S&P went down 18. The NASDAQ, our tech-heavy index, went down 32. And even the Dow Total Stock Market Index went down almost 21. So again, on the down markets, there's protection in these portfolios with diversification. 2023, hey, a 60-40 still did very well, and well beyond that target return, of 6%, was up 15. But again, probably what we were hearing about in the news was the S&P 500, the NASDAQ, that NASDAQ 44% increase. So it's important to not just have short-term focus here, and to keep some long-term memory of the prior year, because over that entire 2-year period, you start to see the NASDAQ was still down, the Dow would have still been down from where we started. S&P was up a little bit, but the 60 and 40 stayed positive. So again, very important. That's why we try and do these longer term average projections about our expectation. Okay, so now that we've told you all about target rate of returns and diversification, how do you find your target rate of return? Well, our first go-to is ask your advisor. I know when Rick meets with his clients and I meet with my clients, we really try and emphasize, whether we are on track for the long-term plan, and are we keeping up with that target rate of return? Every year, individual year return may never meet that target exactly, but some years will be up, some years will be down. But again, if you're on track for the long term, that's the most important number. So, final message here. If you haven't completed a financial plan with your advisor, this is probably the primary reason you should, so you really know what your target return should be and how to evaluate it. And remember, I always say this, the investments are just the tools. We want to use the best tools possible. It's our job. We want to have them in the right weightings to make that beautiful dish that everybody likes. But you really want to make sure that it is for your goals, short and long term, and your success in the long term, into retirement, into perpetuity, if that's your goal, that your plan works for you and that you have the right portfolio designed for you. So with that, Rick, any final comments?
No, I just kind of emphasize what you said. I mean, a lot of people think about investing and financial planning as separate entities, and they really aren't. They are highly integrated, and incorporating that target rate of return and the model portfolio to match what your financial plan projects in the future is very important. Without the two working together, they're kind of just two ships without rudders, knowing what they're doing. The term wealth management has been used here recently quite a bit. And I just see that as it is the integration of both investment management and financial planning. But every person is individual. Every person's needs and goals are individual. Every client has different risk tolerances. I call it the sleep factor. Can you get a good night's sleep after you get your portfolio's performance report? If your portfolio is invested properly to match the target rate of return assumptions in your portfolio, in your financial plan, that's completely different than kind of the random, well, what's the market going to do tomorrow or this year or next year? It takes a lot of that anxiety off the table in knowing that the rates of returns assumptions are well based in substantial academic research, but it's manageable. I mean, we can watch it year to year. As one of the biggest things Leanne pointed out is, I remember back 20 years ago when we argued whether an 8% or 10% rate of return assumption was good. And maybe back then it was, but this needs to be watched on an annual basis because clearly we're not getting average annual returns of 8, 10, 12% anymore. It's calmed down a little bit. And we're aware of that and we know that, but we've adjusted that inside everyone's financial plan. And so modeling the portfolio to match and meet or beat that is really the important factor here. So if you haven't gotten that return and you understand that connection between the portfolio's rate of return and the assumed rate of return in the financial plan, it's a very keen relationship to watch.
Right. And with that, we thank you for joining us.